We are living through one of the worst housing crises in modern history. A 2019 study revealed that out of 200 cities globally, 90% of them were considered as unaffordable to live in. That was 3 years ago, and the events which have occurred since then have only served to worsen the crisis. In the first quarter of 2022, it was found that 83% of the largest regional housing markets in America had properties which were overvalued by more than 10%. Just 2 years prior, that figure was 19.5%, and even in 2007, during the housing bubble, it was only 63%. Housing affordability has continued to worsen not only in American markets, but also across European markets and around the world. Now, however, we're starting to see some signs of a potential downturn in the housing market, and many people are worried that a crash on the same scale of 07-08 is on the cards, with the fear being that this would cause another great recession. So in this video, we're going to discuss the state of the global housing market. We'll talk about where we're currently at, the likelihood of a crash, and what all of this means for you as a prospective home buyer or indeed as a current home owner. Globally, house prices since 2015 have risen significantly, and this can clearly be illustrated using the OECD's interactive chart for house prices. This chart shows the increase in both nominal and real house prices since 2015. Nominal house prices are house prices inclusive of the effects of inflation, whereas real house prices exclude inflation. This is important for understanding whether or not house prices are increasing as a result of inflation or as a result of higher demand, or indeed a combination of both. On this graph, nominal house prices are represented by circles, and real house prices are represented by diamonds. 2015 is set as the base year and is represented by the number 100, meaning all prices in 2022 are being compared against prices in 2015. The higher the number is above 100 for a given country, the higher prices have risen. Using an extreme example, we can see that nominal house prices in Turkey have increased by 186% since 2015. However, real house prices have only risen by 24%. That difference makes sense when you understand that Turkey is experiencing very severe inflation rates, and therefore that inflation is included in the nominal house prices, but excluded from the real house prices. In markets like New Zealand, real house prices have increased by 66%. The United States and Canada have seen increases of over 50%, while my home country, Ireland, has seen real prices jump by 36%. The bottom line is that in almost every market within the OECD, house prices have increased significantly since 2015, on both a nominal and real level. But what's most important when assessing the housing market isn't necessarily prices, but rather the relationship between prices and incomes. This is what's known as the price to income ratio, and it's a key measure of housing affordability. Data from the OECD tells us that in every OECD country bar 3, housing affordability has worsened since 2015, with countries like New Zealand and Canada becoming significantly unaffordable. Essentially, what's happening here is that house prices are increasing at a much faster rate than the incomes of individuals who are looking to purchase those houses. However, as was stated by the Central Bank of Ireland in a recent report, higher positive deviations from long-run averages of price-to-income ratios have historically been associated with higher probabilities of house price declines in the future, especially when shocks occur. In other words, the more unaffordable housing becomes, the more likely it is that a housing crash will occur in the future, especially when the market is put under pressure. This is why people are comparing our current housing market to the market which existed in 07, where affordability had worsened and prices ultimately collapsed. So let's discuss whether or not it's reasonable to expect an 07-esque housing crash in the future. According to the paper, The Housing Meltdown, Why Did It Happen in the United States, US house prices increased by 67% between 2000 and 2006, but critically in the same period, mortgage debt more than doubled. You see, back then the housing market in the US was propped up by bad loans, and lots of them. This resulted in many homeowners having very little personal ownership or equity in their homes. When that happens, the risk of negative equity increases. Negative equity is where the value of your property is worth less than what you owe the bank. This is problematic not only for homeowners, but also for banks, because all of a sudden, should the borrower default on their obligations to repay you, you now have a claim over an asset that won't even cover the cost of what you lent out in the first place. Contrast this to the run-up in prices which we've seen in the housing market today. According to Black Knight, tappable equity, being the amount of cash a borrower can take out of their home while still leaving 20% equity on paper, hit a record high of $11 trillion collectively this year. In other words, homeowners own a lot more of the value of their homes than what we've seen historically. We also know that total mortgage debt in the US is less than 43% of current home values, which is the lowest on record. Essentially, what all of this means is that the housing market today is much healthier than it was in 07. And even if prices were to fall significantly, there will be a significant cushion there to protect against negative equity. You see, the critical difference between today's housing market and the market which existed back in 07 is regulation. After the Great Recession, regulators around the world wanted to prevent a similar scenario from ever happening again. In response, many countries introduced a series of macro-prudential policies, the goal of which was to promote financial stability and to avoid excessive risk-taking. In plain English, strict lending rules were introduced which lenders had to operate. If the potential borrower didn't meet the lending criteria, they weren't getting a mortgage. End of story. So just because house prices are high and affordability is low, that doesn't necessarily mean we have an 07 style crash on our hands, because the mortgages underpinning the houses themselves are much healthier. That's not to say that prices won't fall, because they will. We've already established that higher than average price to income ratios are indicative of higher probabilities for housing price declines. But even looking at where the market is today compared to where it was 2 years ago, it's not hard to see why there's an expectation for housing prices to fall. When the pandemic broke out in 2020, global central banks deployed unprecedented levels of support through unconventional monetary policies, namely the use of quantitative easing. The US Federal Reserve doubled their balance sheet as they proceeded to buy trillions of dollars worth of government bonds and mortgage-backed securities. This was in addition to keeping interest rates at virtually zero, all in an attempt to keep the economy from collapsing. This aggressive purchasing of bonds caused yields on the likes of US 10-year treasuries to plummet to historic lows. That's significant because the yields offered by 10-year treasuries are often used as a benchmark for setting mortgage rates. So when yields collapsed in 2020, it became extremely attractive to take out a mortgage. Naturally, this led to an increase in demand for housing, especially when coupled with factors like working from home, stimulus packages, and the millennial generation reaching prime buying age. But a byproduct of the monetary policies implemented by global central banks has been inflation, and lots of it. Global inflation is at multi-decade highs, a result of not only strong consumer demand, which had been incited by monetary policy, but also inadequate supply due to various supply chain crises attributable to both the pandemic and the conflict in Ukraine. Global central banks are now in a position where they need to get inflation under control, and to do so, quantitative easing has been stopped and interest rates are on the rise. This has had a very notable effect on both treasury yields and mortgage rates in the US, both of which have risen far from where they were in 2020. When interest rates on mortgages go up, the cost of borrowing money increases, making borrowing not only less attractive, but also outright less feasible for many prospective home buyers. It's for this reason we would expect housing demand, and therefore house prices, to fall as interest rates continue to rise. What's crucial to understand is that much of the pressure on housing prices is coming from inadequate supply to meet demand, and that's a key differentiator between the housing market of today and the housing market of 07. The United States alone has a supply shortage of 1.5 million homes, and currently has the lowest housing supply numbers of the last 30 years. On a global scale, it's estimated that the world needs to build 96,000 new affordable homes each and every day to house the estimated 3 billion people who will need access to adequate housing by 2030. Many countries, like Ireland, have submitted government-backed plans to tackle the housing crisis in their respective countries. But ultimately, there are many factors which are outside of government control, namely cost. Residential construction material costs in the US have risen by 19% in the past year alone, making it less attractive to build homes because of lower profit margins. This gives rise to global supply side constraints, which we've been seeing for many months. But now we also have to consider the fresh demand side constraints, which will inevitably inevitably come from rising interest rates and worsening affordability, as much of the market gets priced out. That begs the question of where house prices are going in the short, medium, and long term, and whether or not buying is even an option at the moment. As we discussed in a recent video on the buy versus rent decision, it's more or less unanimously agreed upon that where the cost of buying does not materially exceed the cost of renting, then you should always buy. But your ability to buy is totally dependent on your own financial circumstances and whether or not you meet the criteria that lenders are required to abide by. In the short to medium term, as more and more of the buyer's market gets priced out because of rising interest rates, I think we could see a renewed pressure on rental costs. That's not to say that rental costs are affordable as is, because they're not, with European residential rent prices increasing by 14.5% between Q1 2021 and Q1 2022. But it just makes sense that less home buyers translates into more renters for longer periods of time. As for house prices, CNN listed 5 reasons why they believe the tide is starting to turn for the US housing market, including increases in inventory, price cuts, layoffs in the real estate sector, less mortgage applications, and fewer buyers. I personally can't see there being major price movements to the downside in the short term, and perhaps even the medium term, given that much of the problem lies in supply. This is a crisis of affordability. Until we start building sufficient quantities of affordable housing on a global scale to meet demand, we're going to continue to see pressure on prices. But I fully accept that building enough affordable housing is easier said than done, given that there's little to no incentive for builders to do so, with residential construction costs being as high as they are. And with interest rates rising, we'll see less demand and even higher costs, two further disincentives. As I see it, for prospective home buyers, I think patience is a virtue if possible. For current homeowners, based on the statistics, it's unlikely that we'll see the widespread instances of negative equity that we saw in 07, should a price decline come. Really, what's most important is the health of the jobs market, because at the end of the day, paying your mortgage and avoiding arrears is the utmost priority, especially when rates are rising and interest payments are becoming larger. So long as we continue to see relatively reasonable levels of unemployment, I don't think there should be major cause for concern. But please bear in mind that reasonable unemployment might not be guaranteed should we enter a serious recession. But I want to hear your thoughts. What's your opinion on the current state of the housing market in your country and indeed globally? Are you trying to buy? Are you a current homeowner? Or are you continuing to rent? Let me know in the comments. So I really do hope you enjoyed the video here today. As always, if you did enjoy the video, please do let me know in the comment section below. Leave a like on the video, subscribe to the channel, and I'll see you in the next one. Cheers.